Today, I'm gonna be teaching my friend Jacob how to trade options in the stock market. We had you deposit $500 in your Robinhood account, and we're gonna simulate what a beginner would do, which would be to choose a random stock and buy a random option contract. All right, your order's through. At the end of this video, we're gonna check back in and we're gonna see if you ended up making money or if you blow up your entire account. Do you know anything about trading?
Nothing at all.
Zero.
Never heard of it.
So today I'm gonna cover a really simple, beginner-friendly day trading strategy. So first off, we'll have you pull up your Robinhood. And do you have any companies in mind?
Maybe, I don't know, Apple?
Apple, okay, so we can look up Apple, AAPL. And with options, so options are this way where you can leverage your capital to trade with. So one option contract is gonna give you 100 shares of that stock that you're buying. So if we buy one or two, or we'll see how many contracts at Apple you're gonna buy, keep in mind that these contracts are gonna give you crazy leverage. So there's a lot of upside, but also like there's that downside potential as well. More risk, more reward. Okay, so click on Apple and hit trade. Now trade options. And why Apple? Just curious.
It was the first thing that came to my mind because, you know, the Apple phone.
Fair, the Apple.
Everybody buys an iPhone, so, you know, I think it's a good idea to just trade Apple.
Do you think Apple's gonna go up or down?
I think it's gonna go up.
You think it's gonna go up. So with options, if you think a stock is gonna go up, you're gonna buy what is called a call option. And if you think it's gonna go down, you're gonna buy a put option. So you can see here, we've got expiration dates on the top. We've got January 9th, January 16th, January 23rd. So with options, you have to choose an expiration date, okay, at which that contract will expire. So the closer that expiration date is, the riskier those contracts are, okay? And the further out that expiration date is, the safer those contracts are. Now the closer ones, they're riskier, but you can make a lot more, but you can also lose a lot more. So you can go ahead, you could choose January 9th, January 16th, January 9th. So those are gonna be the closest expiration, the riskiest contracts, keep in mind. And we wanna buy a call, which you're looking at the calls. Now you can see the share price here, 262.11. Now with calls, anything below, so the 260s, the 257s, that's a strike. That's what it's called, strike price. So any strike price below the current share price, any of these are gonna be all safer contracts. They're called in the money contracts. And that is because Apple is already at that price, right? 262.11. So, you know, if you say, hey, by January 9th, I think Apple is gonna be above 260, you'd buy the 260 call, and it already is above 260. So those are worth a bit more. They hold more value now. Whereas on the other hand, the 262s, the 265s, Apple's not there. It's still got to move up to that point. So now you're making a prediction. You say, I think it's going to go up by this time instead of I think it's just going to stay here by this time. So these are going to be riskier. You're going to be able to make more. You can see they're also cheaper. So when you look at the price, like 0.21, 0.44, because options are leveraged, that is just going to be $21 or $45. You just got to move the decimal. So because of that 100 leverage, okay, on that contract. Now we are going to obviously be buying however many you want with your $500. So you could choose in the money contracts, safer, out of the money contracts, riskier, and we can buy as many as you want. So $45, those are almost $100 per contract.
I think I would just hit it at the 262.5 because it's like really close to it, and since we're taking like a short-term trade, I think this one is the best one.
So slightly out of the money contracts,
yeah,
but not really far out. Okay.
No, really. Yeah.
So you could click on the 260-250 calls, and it looks like right now they're going for around $198 per contract. So we could buy two of those. Now you could choose two. And when it comes to getting filled on your trade, there's what's called a limit order and a market order. Now a market order, you're just gonna place that order for two contracts and you're just saying, hey, I'm okay getting filled at whatever price I get filled at, okay? Which is gonna be somewhere in between the bid and the ask. Bid is where buyers are looking to buy it, and the ask is where sellers are looking to sell at. So, you know, that's like saying, hey, I just don't care. I'm just going to get in this trade. I'm going to get in as soon as I can. I might end up overpaying a bit for this position. Whereas if you send in a limit order, you're going to specify exactly how much you want to pay for that contract for that position, however many contracts you're buying. And so you can actually say, hey, I want to get filled at 198, but you might not get filled, right? Because this is a marketplace. You're waiting for then someone to sell those contracts to you at that price. So if we want to just get filled right away, we could do a market order. If we want to actually specify a limit price, we can send in a limit order. Do you want to get in right now? Do you just want to get in?
Let's just hit it.
So we would switch this from a limit, and it's just important to know the difference, right? And you're going to change that to a market. And now we can send that order through. You're going to click review. Okay. And then you're going to swipe it up to submit. All right, your order's through. At the end of this video, we're gonna check back in and we're gonna see if you ended up making money or if you blow up your entire account. So now we're gonna hop on inside my computer. We're gonna cover a real strategy, okay? That was gambling. Don't do that, but it'll be fun to see what happens. So what we're gonna do now is we're gonna pull up my broker, and this is gonna be a day trading strategy. So we're gonna be on a 1 or a 5 minute time frame. So when we look at these charts, you see all these candlesticks, right? So right now we're on a 5 minute time frame where each candle represents 5 minutes of time. So that's a shorter term time frame. We've got 1 hour, 4 hours. You can go up to a weekly or even a monthly. And we're then going to apply this indicator. Now this indicator is called the MACD. So I'm going to type in MACD. Okay, and MACD stands for Moving Average Convergence Divergence. Now we can see these lines on our chart that are intersecting, and we can see these bars. We can see these red bars and these green bars. Now we're gonna use these lines and we're gonna look at them, okay, and we're gonna decide when to enter and exit a position, a trade, depending on where they're at. Okay, so the first thing we wanna do is let's pull up a stock, let's say Microsoft. Now, if we look, we're gonna look back historically first, and we wanna see how these lines interact, because the idea is that when the MACD crosses, now, whether it crosses to the downside or to the upside, we are then gonna enter our position, either betting on that stock to go up or down. So if we go back to yesterday, right off of the open here, so this gray area, this is gonna be pre-market. The market's not open yet. We can't buy options in that gray area. The black area is market open. And then this is aftermarket, pre-market, market open. And so if we look yesterday on a 5 minute time frame, we can see here off of the open, look how close our lines came together, okay? Our moving averages. See how close they came together? Yeah. And what we're looking for is when they actually cross, okay? So you're trying to see if one crosses over to the downside or under to the upside, that is gonna be our, again, long or short signal. So I'm gonna look for a really clear example here, okay? We're gonna find a really clear example here, okay? So pre-market, we could see the MACD started to diverge. When I say diverge, that means that these lines are getting further apart, okay? So the distance of these lines are getting further apart. That tells us that the speed of the stock we're trading is increasing. It's moving faster. Now, when the lines come together and they get flat like that, that means the speed has slowed down. And when they cross, that means the direction is shifting. And so you can see here how heading into market open, we were moving pretty fast. And then right off of the open, look how all of a sudden they came together, they crossed, and then this thing flipped over, okay? So when it crosses, when the blue crosses over this yellow, that is gonna be a short signal. And when the blue crosses above the yellow, that is gonna be a long signal. So we would short here, okay, and we'd buy calls here. So again, let's just look for a bunch of examples just so you can gain an understanding on this whole concept. Pre-market, a lot of the times we're gonna look during pre-market, we're gonna see that a stock will get flat and our MACD will come together, it will converge, and then we'll see a directional move off of the open. And so, for example, here, we can see we crossed under to the downside. You can see here how we started selling off. We could then see our speed starting to increase as our lines got further apart. Okay, so again, these bars are just measuring how fast the stock is moving. If they're red, it means it's moving down fast. If they're green, it means it's moving up fast. And so we use that as like a momentum indicator to see when we start forming smaller bars, that means our momentum is dying out, that things are slowing down. So we were like going straight down here, bigger bars, bigger bars, bigger bars. Okay, started to kind of slow down here. Oh, and then we got a couple huge bars. These all were about the same, right? About the same length when we look at that bar proportionally to the next, You see that? So we weren't seeing like larger bars formed. And that means that the speed of Microsoft was slowing down, and you could see that is where we did bottom out there. Like that was on the chart itself, that was that low at that time, okay? And so we would then, at that point, we could have obviously shorted off of the open when we crossed over to the downside. And then as we started to bottom out here, now it would have been, again, kind of, hey, let's see if we're gonna form larger bars or smaller bars, and we kept forming smaller bars up until the point where we flipped, right? And you can see how they converged, they came together, they crossed. This is a point where you would have been like, okay, they crossed, let's buy calls, let's bet on this thing going up. And you can see here how we started moving to the upside. And so again, the theory is that you're not going to be right all the time, but with trading, we're looking at two variables. We're looking at our win rate, so that's how many times we're right out of 10, and we're looking at our risk to reward. So when we're right, how much are we making? And when we're wrong, how much are we losing? And so with a 5-minute MACD, a lot of the times we're going to get false signals. There's going to be a lot of crosses. With a 1 minute, we're going to see even more false signals. You can look on a 1 minute. Sometimes it might be right. So like, for example, here, off the open, we cross, look at that. We've got calls up to the high, and then we flip over and we start trading back to the downside. You can see here how we move down a bit. We come together. There's a little bit of indecision here. We cross back below, and then we kind of trade sideways for a bit, cross back above, and then we move up. So like the frequency at which we'd be making trades would be like, you know, many trades. Every time we're getting across, we'd be either entering puts or entering calls. Again, trading short or long, just depending. Now, if we step back and we look at a larger time frame, we're gonna see less crosses. And typically when we do get crosses, they're gonna be more accurate, okay? They're gonna be easier to make an actual trade from entry to exit on. So a 15 or a 30-minute time frame is still gonna put you in the realm of day trading. You're gonna be buying and selling, and if you're on a 30 minutes, it's probably gonna be like 1 to 2 hours that you'll be in that trade, maybe a little bit more, just depends, but you'll be in and out within the same day. And so if we look here at a 30-minute time frame, again, we're looking at historical examples, and then we'll actually look at some live examples, and we'll try to time out a couple trades. So yesterday, we could see our cross here. When we crossed, if we bought calls at this point, we would have entered here, and throughout the day, Microsoft traded up. So like that call would have gone up in value, okay? And we can look at the speeds. Today, same thing, pre-market, they converged, they crossed off the open. If we bought calls here, look at that, we would be up, okay? 2%. So go back again. Sometimes in this case, we'll see, okay, they came close, but they didn't cross. So we wanna look for clean crosses. Pre-market got flat, crossed to the downside. We sold off for the whole day. And then pretty much at the close, they came back together. So that would have been a short position. You see what I'm saying? So I'm gonna have you, I'm gonna pull up a couple different stocks, and I'm gonna have you actually look and try to identify when we would have entered and then when we would have exited. So again, the entry is going to be when we cross. We would have entered here, and then the exit would be when we cross again. So we would buy calls, we'd bet on C going up, we would have entered here, okay, we would have traded the move to the upside, and then we would have sold here when we made the next cross. You see how that lines up? So we've got the entry here when it crosses, and then when it crosses below, we would sell. So that would have been the trade. So I'm gonna give you the mouse. We can just go back in time. Again, this is gonna be on a 30-minute time frame. And we can look at a couple different stocks, and we can see if we can identify entry and exit, either calls or puts. So let's look here.
We can see here that there's a crossing here, and we can play on the downside of it.
Yep.
And by the end of the market, we can see that it's crossing again, but it's at the end of the market, so it's like hard to detect, I think.
We got to make sure, because we're trading an option contract, then we can only sell that contract during the market open. We can't sell it after market or pre-market. This is when we would exit. So like you can kind of line that up and see it was right before the market closed. It was getting close, right? And that's the close right there. So it was like right as the market closed, we would have gotten out, but we would have still capitalized on that whole move.
Oh, here there's also a crossing when it's going from the downside of the market.
Yep.
When the market turned on, it's exactly crossed.
This was a kind of choppy day. I don't really like how that looks. I mean, not super clean movement. We can look at another stock. Any other stocks in mind?
Maybe we can check the Apple.
Well, not yet. We'll check on Apple at the end of the video, okay? So one thing that I do every single morning is, let's look at Tesla. I'm trading this system, this strategy, along with a couple other confluences. So I use a couple other indicators, and I trade it live in front of hundreds of people on Discord. And so this morning, and maybe I'll throw a replay in here, we actually took a trade based off of MACD cross where we shorted to the downside. It wasn't a huge trade because I was on a 5-minute time frame, but it was a 10% trade. So if you can beat my 10% trade this morning, if you make more than 10%, maybe you're a better trader than me. Maybe this is going to be your new thing, but we are essentially not every day we're going to find something. I think that's also important to realize is that when we're looking back and we're looking at these historical days, you know, some days it's either not clear or there was just like no, you know, directional move we could have traded. Some stocks just chop around and don't go straight up and don't go straight down. And so it's not that I'm taking trades every day. We're going to have to look for those right opportunities, especially with MACD, with the MACD cross. We want to be really precise. If we want a high win rate, if we want to win more of the trades than we lose, we're going to have to look for those really good opportunities. So let's pick out like 2 or 3 more really solid opportunities, but let's look for, again, shorts, so puts or calls, longs, and then just tell me, hey, we'd get in here and get out here. Just so I understand you get this concept.
Do we only talk about on the market?
Let's look for, in the market when
All right.
the market was open, not pre-market. Although you can keep an eye on stocks during pre-market. You can look at those stocks and, you know, say you'd have a watch list of 5 to 10 stocks heading into market open where you're looking for that cross to happen right as the market opens.
Here we can see like exactly here that there's a crossing and it went like really hard downside.
Yeah.
So we could just sell here and then we could see that this is the longest and now it's probably gonna get shorter and shorter and go to the upside.
Yeah.
So we could invest around here.
You-
Here the line crosses.
That's good. So you would have gotten out a little bit earlier before the line crossed, knowing that the momentum started dying out. I like it.
It's kind of risky, but if you believe that the lines will still get better for you, then I think it's a good choice.
I agree. That was a good one.
Here you can also see the cross again is just straight down, but here it's more like riskier because it's going up and down, and here you see the tendency that they're almost the same. So this is more risky, but you should invest in the, I mean, it was right before the market closed, so that was a pretty weird day for investing, but yeah.
Would that be a put? You'd buy puts, shorting?
Yeah.
Okay, let's find a call where you would buy calls betting on it to go up. And maybe Tesla's just been trading down, you know, moving down all week, and we won't be able to find a good example where we would go long. Maybe it looks like mostly shorts this week.
Yeah, it's pretty much going down up here. Here it went up again, so we could buy here.
That's good.
Because we see the green and the lines are colliding, but it's also kind of risky because, you know, with the tendency that it's almost constantly going like good and down, it's risky to trade Tesla stock this week at least.
Yeah, that's great. I like the, I like the TA's technical analysis. I totally agree. A lot of these examples too would have been like, hey, let's watch list Tesla, like watch it pre-market and then see if we get that cross into the open. Let's pull up another stock, maybe Amazon. So here we go. If you are looking at Amazon and let's say it's 11:30 in the morning, okay? Well, how do we determine where that move is gonna fade out? How do we determine when that move is gonna end? Like, how do we call that top? And so we do use the speed at which, again, we're measuring based off of MACD, the speed at which the stock is moving. And we could even see here, because this first bar, this first opening bar, this was huge. This was like maybe 2.5%, 2.5%. And look at the speeds. Look at the speed on this bar. So it shows you, this doesn't make sense, right? It's like, wow, this is a huge bar and we're hardly seeing this like, you know, bar move up in comparison. So you would be blind getting into a move where you're seeing a stock gapping up that much without measuring that relative speed, okay? And then when you see things here start to flatten out, especially at that top, you knew that was high of day. Now, if we just took this off, and I know it's hard, but you gotta pretend like, hey, you can't see this. You're only looking at this context, and you see Amazon's up, say, on the day, 3%. You're gonna have FOMO. You're gonna be like, I wanna get in this. But look at what happens, okay? Yeah, it gaps up a little more. And then what happens after market, it starts gapping down. So timing wise, it's really hard to figure out, again, when to get involved, when to take yourself out of a trade. But we can use these tools to help us kind of figure that out. Now, MACD is just one tool that we're gonna use. I think you understand MACD at this point. And so when we obviously look at your trade, and I think it'll be pretty obvious at a glance if you made a good decision or not on your Apple trade, you'll be able to then see. And then at that point, maybe we can decide, hey, if you made a good decision, how long should we stay in this trade? Because then you can use, as you're in the trade, you can use MACD to figure out when obviously is that stock starting to die out, and when should we, you know, take ourselves out of this position. Does that make sense?
Yeah.
It's kind of this feel that you're gonna have to get through looking at hundreds of stocks and looking back historically, understanding how this works. It's pretty simple. And then actually putting on trades. Start with paper trading. So you shouldn't start out trading with real capital. I know you did. And that's what most people do. You should start out trading with fake capital. So simulated paper money, so you can learn the ins and outs of the strategy and just understand the basics before you're gonna commit real capital to it. And then at that point, once you're like profitably paper trading, once you're making money with fake capital, then you can actually start trading with just a little bit of real money. So whatever that would be to you. And then once you're now making money, real money, then you can start to increase your account. And I think everyone does it wrong. They start out trading with real capital. They're probably trading with way more than they should be. And they're gonna, inevitably lose money and blow up their account. Okay, so again, I think just good rules for everyone. And if you're thinking about obviously getting into trading, which you are, and now you're involved, I would even take a step back and I would paper trade this strategy until you're making money on it. Any questions?
No, not really.
You're a master at MACD at this point. I'm going to show you what my main chart looks like. This is going to be the chart that I use, okay? I think most beginners will throw a ton on their chart and not understand how one thing works, and especially how they're all going to interact with each other. Of course, it has been overwhelming at times. I've been trading for 9 years, so at this point, no. And I know the tools that I use. And like you recognize the MACD on our bottom here, this is going to be my chart when I'm live trading every morning. You'll be able to see MACD on the bottom left. You'll see my envelope system. And so we'll get you in the mentorship and you'll be able to learn the system and again, kind of watch me trade every morning like you are now. Then you'll be able to connect all the pieces to the puzzle and build a profitable trading strategy while learning at the same time. But we'll get you on paper capital because that's definitely the smart move. I'll put a link in the description if you guys are interested in trading with Jacob and I. And with that said, let's check in on your trade. And let's see if you ended up making or losing money. Oh, you're down. You're slightly red, but like, you're up. Okay. Pretty much break even. You're up $2, $4. So let's pull up the chart. Okay, let's pull up Apple and
$6.
Let's see how you're doing. Okay, so here's Apple chart. We got in at 11:50. This is on a 5-minute time frame, so 11:50 right here. So you actually got in 10 minutes after MACD cross. This was MACD cross. This was our first green bar. On this bar, you got in. And so, honestly, that's not bad. I think that was a little beginner's luck. Now, what do we think at this point where we're trading right now?
I think it's really unstable, but it's going up constantly. We're $8 up now.
$8 up. It's kind of just chopping around. Let's look at a 1 minute. And again, you're going to want to choose a time frame to actually stay on. So like
it crossed.
It just crossed. It did just cross on a 1 minute. That's a really good sign. Okay. But choosing a 1 or 5 or 15 or 30, whatever time frame you're going to trade MACD on, you want to stay on because the context is going to change every time you look at a different time frame. And so that's really something important to keep in mind, is that you're not going to want to bounce between different time frames. But if we do look at a 5 minute, and let's say, yeah, you entered based on a 5 minute, I know this was just a total guess, you would have actually had a pretty good entry. And right now, I mean, we haven't come together. It hasn't crossed yet. They're still apart. Speeds have died out a bit. It doesn't mean the move is over. And so how much are you up now? $13, $14. All right, what are we doing? What's the plan here? It's gapping up a little. It looks like 260, 244, kind of pointing straight up. It looks like we're kind of breaking out of this range we've been trading in today. $14. You're quiet. What do we want to do?
What can we do? Should we just, because we can
Based
pay
off
out
of what you learned, okay, when we look at the chart, when would we really sell?
when it's we either have the gut feeling or we just sell when it's starting to go down a little bit.
We can sell. The real signal is going to be a cross back to the downside. Let's see if this bar right here, this 5 minute bar, can form above this prior bar. Okay, so we want to see this bar right now get a little bit taller than this one. So imagine now not having the chart and not looking at the chart. You'd just be trading totally blind.
Like gambling.
Like gambling, right? I think you got really lucky though getting into this.
It's
$20.
Skill.
$22. Okay. But what do we see here with the bar?
The bar is going down a little
Bar's
bit.
going down. We didn't form a higher bar.
But now, do we trust it to go back up again?
Well, technically we are
They're close to
There,
closing.
see, look at that, and we just lost a lot of momentum. So 5 minutes ago, we saw that bar actually didn't form a higher.
The blue is like...
So let's close this thing. Let's get out of it. Yeah, maybe. You want to stay in it, don't you? But you're about to dip into the red.
Maybe a little bit. Because it's like $2, you know? It's like...
Yeah.
Oh, we're down 6 now. Now we're only 4 down.
Okay.
But I think the line is gonna cross like...
See how it's coming back?
Yeah.
Well, we know because these, bars are getting smaller, the momentum kind of died out here. I mean, the momentum really did peak out on this highest wick. Are you stressed out?
Yeah.
You nervous a little bit? Okay.
My hands are kind of sweaty. Oh, -2 again. All right, let's just cut the loose.
Okay.
I don't believe anymore.
So we're gonna click on this. Trade, sell.
Oh, did you see we're only -0.26?
Look it. This is gonna be the bid and the ask. Send in an order for 1.97 and see if you could get that filled.
Right,
Type in 1.97. So this is going to be our ask is 1.97. That's review and send it. That should be the best
but
price
if
to
we're
get filled
on this screen, does the price still change?
It is still changing right now.
Also,
You're
we
still
don't
in
know.
it. We don't know. We can see though that the bid is 195 and the ask is 197. So as long as they're not going down, you're still about the same as where you were. And if we send that through, we'll see if you can get filled. It would be nice to get out of this trade break even, but oh, okay.
Perfect.
That's break even. 17 cents.
That's
So that was the difference of a limit or a market order. All right, not a bad trade. Your first one to be break even. It's okay. It's okay. So now we're gonna get you in the mentorship. You're gonna learn how to do this, and we're gonna take some better trades, more educated trades. All right. Thank you guys for watching, and we'll see you in the next one. Subscribe for more.